Thank you for joining us for part 2 of our coaching series. Today we're going to discuss the 5 strategies for pursuing successful investing. Now let's take a look at some of the steps an investor may take, no matter how volatile the markets may become. Before we get started, my name is Kevin Thompson. I'm the investment specialist for White Rhino Financial. If you have any questions, feel free to contact your investment professional. If you want to listen to our podcast, you can go to iTunes and type in whiterhinofinancial.com. If you want to listen to it on SoundCloud, you can type in whiterhinofinancial.com there as well. Or you can go to the website at www.whiterhinofinancial.com to listen to our podcast and some of our coaching series as well. So, when we talk about strategies, let's start with strategy 1. Don't let emotions drive your decisions. Let me start by asking you all this. Can you think of a time that you had a knee-jerk reaction, impulsive reaction to some market world news? I'll tell you this. The field of behavioral finance studies show how people make decisions and looks at how investors behave in real-life financial situations. It teaches us that both positive and negative emotions influence how we make decisions. Fear. Fear rather than rational thinking can lead investors to panic and sell securities after they lost a ton of value, or do nothing and miss opportunities when the markets are going up. Overconfidence, which is the other extreme. Overconfidence can lead investors to take on too much risk. Here's a key takeaway. Stick to a disciplined investment strategy and don't be swayed by emotions. Have any of you gone to the grocery store and shopped while you were hungry? If you're like most of us, you probably got out of the checkout line and realized that you filled your cart with cookies, ice cream, and other not so healthy options. But if you go to the grocery store on a full stomach, you usually end up with a cart full of balanced food. Behavioral finance shows that same logic can be applied to investing. If you make decisions when you're sad or angry or happy, you may end up with your portfolio that isn't well diversified. And it's important to stick to a disciplined investment strategy. Strategy 2, maintain a long-term investment horizon. As I mentioned earlier, when I was speaking about some lessons we've learned from history, markets tend to overreact to short-term noise. So it's important to stay focused on the big picture if you want to keep working towards achieving your long-term investment goals. So, short-term markets, these declines usually are followed by longer-term rallies. We've seen this over decades that happen after market recessions. After a market recession comes an expansion. This image illustrates the value of $100,000 invested in the stock market during the period between 2007 and 2017, which included the global financial crisis and the recovery that soon followed. The investment dropped in value to $45,311 by January 2009, following a severe market decline. If an investor stayed invested in the stock market, the ending value of this investment would be $195,719, ending in 2017. If the same investor exited the market at the bottom to invest in cash for a year and reinvest in the market, the ending value of that investment would be $127,517. An all cash portfolio would only be $54,699. The continuous stock market investment recovered its initial value over the next 3 years and provided a higher ending value than any other of the 2 strategies. All recoveries may not yield the same results, but investors are advised to stick with the long-term approach. Key takeaway: stay invested even during market downturns and difficult environments. Maintaining a long-term perspective means staying invested, not just in up markets, but in turbulent markets. Strategy 3, diversify your portfolio. Don't put all your eggs in one basket. Traditional diversification theory tells us to not put all your eggs in one basket. The truth is that no one, not even the experts, can predict which asset class will perform best in any given year. Diversification recommends managing investment risk by investing in stocks, bonds, and cash. But is that sufficient? Let's talk about how correlation and asset allocation tie into the discussion of diversification. So let's back up a little bit. What is correlation and why does it matter, right? Correlation equals how two assets move in relation to one another. Correlation not only describes how two assets move in relation to one another, but when two asset classes are highly correlated, they tend to move in the same direction. When they're not correlated, they tend to move in opposite directions or independent of one another. Choosing investments that aren't correlated is important in helping reduce the overall volatility or risk of your portfolio. Negative correlation is good for a balanced portfolio. So what are some of the benefits from robust asset allocation? To take advantage of asset allocation, you can start by allocating your holdings broadly across the major asset classes, such as stocks and bonds. Next, you can diversify within each major asset class by investment style, such as growth stocks, value stocks, large caps, mid cap, small cap, etc. Then you can further diversify your market by market sector, such as technology, real estate, health sciences, things of that nature. So to enhance traditional diversification of stocks, you have to go beyond the traditional diversification of stocks and bonds. Some ways to do this are you can go into sector-focused options, i.e. financials, industrial, international, risk-managed options, i.e. long-term financials such as U.S. Treasuries, U.S. notes, alternative investment options, i.e. real estate, commodities, and currencies, which are all less correlated to traditional asset classes. Previously, these options were only accessible through sophisticated investors or institutional managers. Sources of retirement income. Where does the money come from today? Retirement's getting longer and more expensive. That's partly because people are living longer, a trend that's more likely to continue as people have better medical situations and take better care of themselves. At this time, retirement isn't what it used to be. Today's retirees are leading more active lives and often focus on travel, hobbies, and other activities that are typically cost more simply by spending more time at home. Meanwhile, workplace changes are making it more likely that future retirees will be responsible for providing the bulk of their own income. Already, as you can see in this chart, Social Security makes up less than 40% of retirees' income. The question we have to ask ourselves, have you planned beyond Social Security for other guaranteed income sources? The bottom line is that the Social Security system is under stress. We all understand that. And the declining role of traditional assets and pensions, it appears that most people will have to finance even more of their retirement income in the future. So what are sources of guaranteed income? We have Social Security, like I mentioned before, pensions, annuities, which are basically financed by insurance companies, life insurance, which again is there to counteract dying too young, and certificate of deposits, which are basically assets held by banks that are very, very safe. Key takeaway. Reduce portfolio risk by investing across major asset classes, investment styles, and market sectors. Strategy 4. Has anybody ever heard of this? Employee dollar cost averaging? Well, it's called systematic investing. What does it do? It lets you make regular contributions in both rising and falling markets. So in a rising market, right, when prices are higher, you purchase fewer shares. In falling markets, when prices are lower, you purchase more shares. It recognizes the pitfalls of trying to time the market and guess the right moment to buy and sell. By investing regularly in all market conditions, you reduce the overall market risk of your portfolio. Let's take a look at the following charts to compare investing systematically versus investing in one lump sum. These two charts compare hypothetical $12,000 investment made in one lump sum in the top chart and 12 monthly installments of $1,000 each over a 12-month period in the bottom chart. The lump sum investor would have purchased 1,200 shares since the hypothetical price was $10 per share in January at the time of investment. The monthly investor, however, would have purchased 1,451 shares at an average price of $8.27 over the course of a year. Since the price fluctuated up and down over a 12-month period, the investor was able to purchase more shares when the price was lower, such as in July, and fewer shares when the price was higher, such as March. In December, the ending value was $10 per share. The lump sum investor's ending value for the period would still be $12,000, while the systematic investor's ending value would be $14,510. So, in a falling market, the average cost per share would be lower using dollar cost averaging versus lump sum investing. However, in a rising market, the average cost per share would be higher using dollar cost averaging versus lump sum investing. Key takeaway: take advantage of systematic investing instead of trying to predict market performance. Strategy 5. We're talking our own book here. Work with an experienced professional. As a financial professional, a person can be one of your best allies when it comes to a personalized retirement plan. He or she has the experience and the tools to help you develop a sound investment strategy and stay on track in any kind of market environment. Key takeaway: partner with a pro. Let's talk about what a financial professional can do. Well, how are they going to help you? First, they're going to help you develop a plan that balances your competing financial goals. 2, understand what the numbers really mean. 3, tell you what's realistic or what's unattainable. 4, find ways to increase your retirement savings. 5, determine when you can retire. And 6, monitor and rebalance your portfolios as needed over time. What's more, they can help you set clear guidelines on how to navigate turbulent markets and show you how to stay on track and avoid making impulsive decisions. Thank you again for your time. We appreciate the commentary. We appreciate you guys sticking with us and listening to some of these coaching sessions. Once again, here's a little bit of our disclosures here, but we appreciate it. If you have any questions, feel free to contact your investment specialist and or your registered rep. And always remember to rethink wealth.